You've probably heard of the London Breakout strategy, one of the most widely taught and widely known strategies on YouTube when it comes to day trading, but can it actually make you consistently profitable? Today I'm going to code it, backtest it and optimize it to see if this day trading strategy can actually make you any money in the long term. So, before going into coding and backtesting and everything, let me explain what are the basic concepts behind the London Breakout strategy. It's actually a very simple system, and that's exactly why it became so popular. You pretty much only take one trade a day, always at the same time at the start of the London session, since it is normally followed by a lot of volatility. If price breaks out of the range drawn from the previous few hours, you enter in that direction and ride the move for the rest of the session. Let's take a look at a practical example. This is the entry time. It's when we draw the range and start looking for breakouts. We mark the highest high and the lowest low from the candles before the session. If the breakout doesn't happen within the next few hours, then we simply skip the day and wait for the next one. Now, if price breaks above the range, we go long, and if it breaks below, we go short. That's pretty much the whole logic. I'm going to code this strategy using these mechanical rules, then confirm that everything works properly, and finally, we're going to backtest and optimize it across a few different pairs. Now that you know the basics, let's start coding this system. Since this strategy is pretty much fully mechanical, we need variables or inputs that we can test and optimize. First we have the entry hour, where the strategy draws a range and starts looking for breakouts. Then we have the number of bars used to calculate the range, and additionally I decided to also have a close hour, where the strategy stops looking for new setups and closes any trades that are still open for the day. I'm also adding a range size filter based on the ATR. This prevents trades on days where volatility is either extremely low or extremely high. For risk management, the stop loss goes on the opposite side of the range, so if a trade enters a buy order, the stop loss will be placed on the bottom of the range, and vice versa for sell orders. The take profit is always fixed at a 1:2 risk to reward ratio. This gives a nice balance between win rate and overall profitability. This is the code. Here we have the input variables. The ones we will optimize are the entry hour, the number of pairs, the close hour, the max range size and the minimum range size. All the other ones are either to make the debugging of the strategy easier or just risk management inputs. So right here we have the risk, the account balance, the hour difference that I'll explain in a bit, and the drawings. So the drawings are basically whether I want the visual mode to include the drawing of the range and the drawing of the entry and close hour. The hour difference is used to adjust between the UTC time and the actual server time of the IC markets. When in my time zone is 6 PM, in IC markets is actually 8 PM, so it's 2 hours in advance, and I account for that hour difference right here. The account balance is pretty straightforward. I always have it set to 10,000 and the risk to 1%. We check for the entry hour, and if the current hour is equal to the entry hour, using this method right here, where we account for the hour difference, it begins calculating the range. Then it draws the range using the range top and the range bottom variables. It calculates the range size and the minimum range size, as well as the maximum range size. Then it checks whether the range size is inside that specific value range, and if it is, it sets the variable calculated range to true. It runs this method, the breakout. If the calculated range variable is true and there are no open trades, it calculates the current price, and then it checks if the current price is above the range top or below the range bottom. And if it is, for example above the range top, it sets the entry price to the current price, the stop loss to the range bottom, and calculates the take profit as 1:2 risk to reward ratio. Then it enters the trade and calculated range becomes false. Then we have the cancel order. If the hour equals to the close hour plus hour difference, the calculated range becomes false, and then it closes whatever position it's still open. Also, we have a reset day method that checks if today is a new day. So whenever a new day forms, let's say, the range bottom variable becomes 0, the range top becomes 0, and the calculated range equals false. And then we run the cancel order as well. And here is pretty much just the method for calculating lots based on the risk and the account balance we set earlier. Okay, now that we have the strategy fully coded, let's run it in visual mode to make sure that everything behaves the way it should. You can see here that the range gets drawn at the entry hour based on the highest high and the lowest low of the past N candles, and once the range is confirmed and the size is within the ATR limits, the strategy just starts looking for breakouts. Here, price breaks the range to the upside, so the strategy opens a buy position. You can see that the stop loss is placed on the opposite edge of the range, and the take profit is at a fixed 1:2. If the breakout happens to the downside, the logic is exactly the same, but in the opposite direction. This step is crucial because it lets us confirm that the trading logic is correct and that the strategy rules are being followed as intended. To double check that everything works properly, I'll run a quick sped up simulation where the strategy places trades across multiple days. You should see ranges being drawn, breakouts being detected, and orders being opened and closed automatically. This confirms that the strategy handles any number of trades without any issues, so we can now move on to the next step with confidence. Let's talk about how we are going to set up the backtest, because this part is extremely important if we want results that actually mean something. We're going to test this strategy on 4 major pairs: GBP/USD, EUR/USD, USD/JPY, and EUR/GBP. These pairs have consistent liquidity and are closely tied to the London session, so they offer enough volatility for this type of breakout approach. Here we have the strategy input or variables. We are going to optimize the entry hour from 5 to 11 with a step of 1. So this means the optimization will run from 6 to 5, 10 and all the way until 11. The number of bars to define the range will be ran from 2 until 10 with a step of 2. The close hour will be in the range of 6 to 20 and the maximum and minimum range size will have this range and these steps. Like I said previously, we don't need to optimize these variables because they are either to check the visual mode and debug the actual strategy or just to manage risk. And the ATR period, it's not that important that we need to optimize it, so we are gonna just leave it at 100, and this means that the ATR period will use the average size, average true range of the last 100 candles. On the 1 hour, that means the last 100 hours. And as you can see here, the settings for the actual backtesting are going to use the data from 2013 to 2025 with a forward setting of 1/3. The in-sample period will be from 2013 to 2021 and the out-of-sample period will be from 2021 to 2025. We are gonna model the data with 1 minute OHLC. This means it will just use 1 minute candles. It will do the calculations using the open, high, low and close of the 1 minute candles. But there's no need to use every tick on this actual strategy. In recap, our backtesting setup is the following: 4 pairs: GBP/USD, EUR/USD, USD/JPY and EUR/GBP, historical data from 2013 to 2025, forward mode with 2/3 in sample and 1/3 out of sample split, 1 minute OHLC modeling, and full optimization of the session times and range settings and the ATR filters. With all of this in place, we can now start the optimization and see how the strategy performs. In the optimization process, we're basically telling MetaTrader to run the strategy hundreds or even thousands of times using different combinations of the input values we defined earlier. The goal is to find which combination of inputs performed best during the in-sample period. This gives us a much deeper understanding of the strategy, not just whether it works, but when it works, why, and on which pairs and sessions it performs best. While the optimization is running, there are a few key metrics that I always look for. One is the recovery factor. This is one of the strongest indicators of long-term reliability because it measures how much net profit the strategy makes relative to the size of its deepest drawdown. A higher recovery factor means that the system not only grows the account but recovers from losing streaks efficiently. The number of trades is also a big metric and very important because we need a meaningful sample size. And for a day trading system like this, I look for at least 2 to 3 trades per week. Anything less than that makes the results statistically weak and you can't really trust the performance if the strategy barely trades. Profit, how much money the strategy actually makes over the entire backtest. Now, this alone doesn't tell the full story, but it's still a key part of evaluating whether the system has a real edge. Profit factor compares the total profit versus the total loss, and a higher profit factor means that the strategy's profitable trades outweigh the losing ones by a healthy margin. The drawdown percentage. A system can be pretty profitable, but if the drawdown is too large or too unstable, it becomes risky and psychologically hard to trade. We want smooth, controlled drawdowns without big spikes. The win rate can also mean that the strategy is stable across different years and different market conditions, and for a 1 to 2 risk to reward, I'm looking for at least a 36% win rate. After checking these individual metrics, the final and most important step is to look at the in-sample versus out-of-sample stability. The optimization finds the best parameters, and then the in-sample period pretty much validates what the in-sample period tells us, because in the out-of-sample data, the strategy was not optimized and it has never seen this data before. So if the strategy performs well in both periods, similar recovery factors, similar drawdowns, so similar metrics in general, that's a very strong sign that the edge is real and not overfitted. When the optimization finishes, we'll filter the results based on these metrics. Now that MetaTrader 5 has finally finished the optimization process, let's take a look into the actual result. So here for the Euro-GBP pair, we have the in-sample results, and they were pretty weak across all optimization runs. Even the best configuration only produced around 10 trades over the whole data, so 12 years, which is statistically meaningless. And if I organize the result by recovery factor, you can see it's all red because the number of trades is just not enough. And if I organize by profit, we actually have some green ones, but still they don't make the minimum number of trades, or they just have other metrics that combine into a weak recovery factor. Equity curves were also unstable. As you can see, this is the top result for the profit, so the recovery factor is also linked to the profit, so you can take a look. It's a pretty much break-even strategy, with long flat periods and frequent reversals on the equity. The out-of-sample performance also completely failed, as you can see. This pair is just not tradable using this system. There's no statistical foundation, no robustness, and no consistency. Now for the Euro-USD pair, we have the results organized by recovery factor. The story is pretty much the same as the Euro-GBP pair, and if we organize by the net profit, you can see we start having a bigger number of trades, but still it won't hit the bare minimum. With only 300 to 400 trades across the entire data range, it's still on the low side for a day trading system. The metrics such as the recovery factor or profit factor are not impressive, and the drawdown is normally too high for my taste. So let's pick one from this list. We can go with the highest recovery factor that we have here with the 300 trades. And as you can see, the equity curves were messy and inconsistent. This is actually not that impressive. The out-of-sample results also failed, as you can clearly see here. Yeah, this pair is just not consistent, not robust, and fails the out-of-sample. Now for the start of the show, the GBP-USD pair, where this system was actually developed to trade with. This pair produced multiple good optimization passes on in-sample with solid metrics, using different combinations of input values. And as you can see, the best settings are around 9 to 10 AM for the entry hour. The number of the range bars is 6 to 10. The close hour is either no close hour or somewhere between 4 PM and 8 PM. And what I mean by no close hour is when the value of close hour is 8, it means that the close hour only applied 1 hour before the entry hour. So right before entering a new trade, it closes the old one or cancels pending order and enters the new one right away. The max range size is always 1.5 to 2, and the minimum range size is between 0 and 1. 0 being that there is no minimum range size. So let's organize again the results by profit, and as you can see, we have 700 and 900 trades with a good recovery factor. Let's take a look at the first one. But before we take a look at the equity curve, the input variables are also pretty consistent across our results. This is actually a good sign. Now let's take a look at the equity curve. For the in-sample period, the equity curves were clean, stable, and showed good structure. However, our off-sample results were almost break-even, with big deviations in core performance metrics. As you can see here, these are the core metrics of the in-sample period. So we have a recovery factor of 479, a profit factor of 123, and we have an average win rate of 43%. And when we take a look at the forward period, the profit factor drops to 1, the recovery factor is pretty much break-even, and the win rate drops to 39%. So this is not a good sign, and I would not trust this pair. The only time the out-of-sample performance looked acceptable was when the optimization used very few trades. So for example, if we organize the results by recovery factor, we have a total trades of 200 on the in-sample period. And when we take a look at the equity curve on this run, it's pretty consistent across the in-sample and the out-of-sample period. I would still not trust this system due to the fact that there are just not the minimum trades that I look for. This is, in my opinion, unreliable and likely curve fit. So this pair shows potential, but collapses on the out-of-sample period. It's not reliable enough to be traded. Now, for the last pair, the USD-JPY, it was the only pair where the strategy showed real potential. The in-sample metrics were strong, as you can see. We have a ton of runs where the recovery factor was acceptable. The number of trades is also a lot more than what I look for as a bare minimum. Profit factor is consistent. The drawdown is also consistent, even though it's a bit high. And the input values are also consistent across multiple runs. So let's take a look at this run, for example. Here are the metrics for the in-sample period. So the profit factor was 115, recovery factor 427, and the win rate was around 46%. While in the out-of-sample period, the profit factor was 112, the recovery factor is 1.56, and the win rate stays around 46.5%. Even though the recovery factor is a lot lower than the in-sample period, this still shows promise to the equity curve looking like this. So we still have potential on the out-of-sample period, and this means that the system is not overly sensitive to exact parameter values. This is a key sign of robustness. In conclusion, this is the only pair with clear potential and deserves a deeper analysis and testing, but I would still not trade it as it is. Now, to answer the question from the start of the video, can the London Breakout system make you profitable long term? We have the pairs that definitely don't work, so Euro GBP and Euro USD fell for the same reasons. A few trades, poor metrics, unstable equity curves, and completely out of sample failure, and these pairs do not respond well to a breakout methodology, especially around the London session. The GBP USD looks great on in sample but collapses on out of sample. This indicates that its apparent performance is heavily dependent on the exact parameter values and specific market conditions. This lack of stability means that it's not reliable enough. Only one pair stands out, USD JPY, the only meaningful candidate since it shows consistent structure, strong in-sample metrics, and stable out-of-sample metrics, and it also has multiple viable parameter clusters. This suggests that the breakout behavior on the USD JPY around London hours is structural and not random noise. So to answer the question, on most pairs, the London breakout system cannot make you profitable, since the edge simply isn't there. But USD JPY shows real promise, and if you want to build something robust out of this concept, that's the only currency pair worth diving into. I'll provide the HTML reports if you want to take a look by yourself. They're available through the download link in the description. I hope you liked this video and subscribe for more trading content.